Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our market review here on Core Finance TV. Now, we had to drag him away for the excitement of these financial markets here, but we have Jeremy Stretch, Chief Foreign Exchange Strategist at CIBC. Well, Jeremy, I mean, we've only got 15 minutes, so where do we start?
Well, indeed, where do we start in the week when we've had Eurodollar north of 120?
Well, I mean, it's a situation as we saw right there, January 2015. You know, everybody now saying, you know, is the euro the new safe haven currency? Every time we have every hour on the hour, it seems like we have another problem with North Korea.
Well, I think traditionally you look at the yen and the Swiss franc as the two obvious currencies of safe haven status. But in a sense, you need to understand why that is the case. And of course, it comes back to that current account surplus nature. And of course, one other currency which does have an enormous current account surplus is the Eurozone. And when you remove some of those political risks which were really bedeviling the currency over the course of the last 4 or 5 years, and certainly through the first quarter of this year, when you remove that political risk, then of course in an environment where there is a degree of political uncertainty and risk aversion, then you're naturally going to find that currency in terms of the euro will benefit.
Look at the chart here, okay? As we saw, you know, we can look at the technicals and the fundamentals, and as we saw last week when Magic Mario basically said, well, I'll get back to you in the morning, in reference to whether he was going to be bullish, bearish, whether he was going to go repeat what he said in Lindau and repeat what he said. But the question being is, we saw it trade 120 plus, I think the highest since January of 2015. But as we've seen now, mid-1850s or something, is this strictly just profit taking ahead of next week's ECB meeting?
Well, it would make sense to do that. Now, we ourselves have been running a long position in Eurodollar since 110.65 back in late May. We took profit north of 120 at the beginning of this week, so nearly a 10 big figure profit. If you've been running that sort of trade, which has been trending very nicely over the course of the last 2 or 3 months, ahead of that ECB discussion next week, it does make sense to take a little bit of profit. Now, of course, as you quite rightly say, the euro got traction off the back of what Draghi didn't say at Jackson Hole last week, because he didn't signal any overt concern or fear about the valuation of the currency. But when it is north of 120, that is closer to the sort of equilibrium or fair value measures. Now, I would say probably Eurodollar fair value is probably somewhere away, maybe 128 to 129. Other metrics are maybe 122, 125. So north of 120, I think that did make markets nervous that the ECB could signal just a little bit of a too fast an appreciation.
So basically what we're looking at, okay, tomorrow non-farm payrolls, Tropical Storm Harvey, U.S. holiday on Monday. So basically we could see almost really nothing until next Tuesday. Now, I have another question for you. Back in January of this year, if we can remember way back then, everybody was talking about euro at parity. Now, I'm getting confused now. Did they mean euro dollar or euro sterling?
Well, I'd like to say that we weren't looking for Eurodollar at parity. That's the first point we make. We were actually pretty bullish on the euro at the beginning of the year. So we were talking of something like 110 by the middle of the year. Well, in fact, that didn't actually prove to be bullish enough because, of course, we've obviously seen this significant appreciation. Now, you're right that it's very easy and very flippant to talk about euro sterling at parity, but clearly there is still sterling negativity generally playing out. I think euro sterling still has additional top side. We saw the highest closing level in 8 years earlier this week. Yes. Now, we haven't breached the intraday highs from last year at north of 94, but I think that seems very likely over the course of the ensuing days and weeks, because the UK interest rate story is going nowhere fast. The consumer is finding it increasingly difficult to maintain expenditure. And of course, the negotiations between the UK and the Eurozone, as we come to the conclusion of the third round of face-to-face bilateral negotiations, doesn't appear to be going terribly well.
Now, could we have egg on our face at the end of the third round today? I mean, all I hear is negativity, and even more negativity. Are they taking the proverbial, PISS out of us here with this situation? I mean, are they just laughing at us, not only behind us, our back, but almost to our faces right now?
Well, I think what we have to remember is that negotiations, which are intense and fraught, are being played out almost in the focus of the media. So in a sense, I think you have to accept that even if you assume that pragmatism may eventually prevail and there will be some degree of movement on both sides, and I think that is an important point, there does need to be a movement and not intransigence on either side, But until we get to that final stage, there is going to be this sort of jockeying for position or superiority, or in terms of sort of an enhanced position. And in a sense, that's where we are now. So the news flow is always going to be negative. That was one of the things that we did anticipate. We thought the news flow would probably get worse before we get any resolution, and that's symbiotic of the fact that we still think that euro sterling has some upside potential. I don't think we go necessarily to parity, but nevertheless, euro sterling has still some upside potential as these headwinds and these political uncertainties are played out in the full glare of the media.
Well, let's look at the next chart here, okay? I think this is the proverbial chart this time last week, okay, as we were struggling at 109-ish and heading south, okay? Everybody was saying, what would Yellen say? What would Draghi say? And everybody was saying, well, is 108.50 the level? Well, as we saw, we got close to that. We didn't take out the 108.13, and now we've just gone the only way. Now, one of the things, again, with last week, Draghi basically said nothing. Now, I had Mark Oswald here last week, and I said, Mark, do you see any possibility of Janet Yellen being any way political in reference to her speech? And he said, well, that's not the job of the central bank. Well, as we were discussing earlier, just in her one or two comments in reference to, she didn't name them specifically, but Dodd-Frank and the Volcker rule, I thought that was quite a political speech. Now, does that mean she wants to be reappointed, or saying, thank you very much, 31st of January, I'll start selling the big issue?
Well, you're right that it isn't notionally the job of a central banker to be involved in political regulatory debates. Now, and central bankers are normally very keen to avoid political or overtly market-moving statements in most instances. But clearly Janet Yellen decided to eschew that last week. Now, I would take the view that in the context of the way that she spoke, and obviously the language that's been coming out of Capitol Hill in terms of the regulatory changes or potential regulatory changes, there seems to be a mismatch between what's coming from the White House and what's coming from the Federal Reserve. So for me, that suggests rather more that Janet Yellen has resigned, or is quite keen to suggest, well, she's done her tour of duty and isn't necessarily keen to be reappointed for another term. So to me, it sounded more like somebody who was reminding the market and reminding investors of the inherent benefits of some of those regulatory changes, and threatening, or just leaving a parting gift, perhaps, in terms of just reminding markets of what could happen if there were to be a rollback.
Looking at dollar yen here, this is just basically a question of rhetoric from North Korea, up, down, sideways type situation. Now, looking at tomorrow's non-farm payroll, is that going to be a non-event? I mean, yesterday's ADP number was astounding. And I mean, even people were talking, my call is 180. That, and I was a number of people saying, well, it's going to be closer to 160, 165 because of the quirk 2-day working difference between August and July. So that could have a negative effect. But I'm still talking 180, 2.5%. for average earnings, and of course 4.3%. So I mean, could tomorrow's number, mainly with Tropical Storm Harvey and a Monday holiday in the States, could this sort of be, unless it's 400,000 or 100,000, be a total non-event tomorrow?
Well, we have seen a succession of non-farm outcomes which have been rather more of a non-event variety. I think you're right that unless we get a headline number which is really deviant to the median expectation, we're looking for around 170. So I think unless you get probably north of 250 and sub 100, then I think we probably are going to be more, sort of essentially in range. But of course, it isn't really the headline payrolls number that really matters anymore. It's the average earnings number, and that's the real kicker. So, whilst we've been talking about the deterioration of the depreciation of the dollar over recent weeks, that's been, of course, contingent on the reduction in rate expectations. So the probability of that December Fed hike has been gradually diminishing. It almost got down to a merely 1 in 4 chance at the beginning of the week. We have recovered a little, and it's recovered partly because of ADP and partly because of consumer confidence. If we were to see some signs that inflationary pressure is not building, but certainly is not quite as dormant as perhaps markets have started to fear, then you start to get the question of where does that imply for Fed funds expectations?
Because, I mean, it looks like, again, September will be the announcement of the pay down of the outstanding 4.5 billion, and then probably December, and the market's only implying 27 basis points for next year.
Exactly. I mean, we're currently in a scenario where the market believes the Fed dot projections are wrong. Now the question is the market right, or will the Fed dot projections prove to be correct? Well, the real proof in that will be in terms of not just in terms of the activity data, but more so on the inflation side. And I think that's where that's where the interest comes in terms of determining who is right, whether the market is right or whether the Fed will prove to be rather more relevant.
Because you just mentioned a valid point. Who is right, the Fed or the market? And I just go back to the comment Greenspan made. She in the mid-'80s was saying, he was asking a question off the record because we used to have a bond market Christmas party. This was before Snapchat, and it could be totally off the record. And one of the questions he was asked was in reference to that, and he said, oh no, the Fed reacts. You, the market, tell us it's the right level. We just react accordingly.
Well, that's an interesting point, and whether that still necessarily holds quite to the same tenet, because of course central banks like to try and guide markets, and that of course has been the real lesson of the post-crisis world, that central banks have really tried to guide markets to an extent that almost market participants have almost felt as though they need to be led.
Let's look at it just at our okay. The key thing here is, where do we go from here? I mean, I know earlier this year people were talking 130, 134, 135. Then they started to change it once, especially they changed it again after the sort of snap election in June. I mean, we're struggling here, 128 plus or something like that. Where do you see it going? More from a political standpoint or an economic standpoint?
Well, from an economic standpoint, it's very tough to be particularly overtly optimistic on sterling because I've mentioned the rates are going nowhere and the UK consumer is struggling, so growth will be sub-trend. I think the offset of that is, of course, we do have the political ramifications as well, as we continue to have a relatively weak Prime Minister, although Prime Minister May is suggesting she would like to serve
I'll be here for the duration.
Fight another election, which suggests that her walking holidays do tend to cause her with a little bit of oxygen.
It must be the altitude.
Because obviously the Easter walking holiday didn't go terribly well either. So there are political dynamics. I think as far as sterling against the dollar is concerned, I think it is more of a range trade, because I think effectively what we're looking at is euro sterling and euro dollar. Euro dollar, I think, grinds higher, probably without the same sort of trajectory of impetus that we've seen in the last 3 months, but I think it does grind higher, and euro sterling probably suggests that the cable is in a sort of a 127, 131 range, and I think you sell it and buy it accordingly.
I mean, this is going to be more of an action-reaction about where maybe dollar-yen is, where maybe euro-yen is, euro-sterling, and of course the cable will just be an action-reaction.
Well, exactly. I mean, traditionally we always used to find that cable was the best barometer of political risk in the UK. I think that probably doesn't hold sway in the same way that it would have done 5, 10, 15 years ago. I think now it's more about a barometer of where euro sterling is going. So obviously when we were talking about the safe haven status of the euro earlier, then obviously that played into the euro sterling spike earlier in the week as well. But I think it's more about that's where the political risk will be seen more graphically in the current environment rather than necessarily in terms of cable.
Well, let's look at our last chart very briefly. I thought I'd do this since you do work for a Canadian bank. Last 4 months, 138 to 124. And I saw this morning WTI, 47, although, gasoline futures have gone for 7 consecutive days. So you're seeing gasoline really going to the moon and oil prices going down here.
Indeed, oil prices aren't providing any real support for the Canadian dollar in the current environment. And I think what we can see is that we're showing a dramatic move here. If you actually looked at the way the market is being positioned, you'd also see almost a mirror image. So we saw enormous net shorts completely reversed into sizable 4-year highs in terms of net longs. The question is the market still a little bit too long of Canadian dollars? I suspect it probably is, because although markets are still mindful that the Bank of Canada could hike rates as early as next week's meeting, that seems rather unrealistic. And I think October is a much more likely scenario. So I think we do see the correction in dollar CAD from the sort of the low 124s and a bit of a double bottom down there, extending a little bit further. And we could easily see a sort of a 128 print in the course of the next month or so, unless the Canadian data proves to be remarkably more resilient than we assume, or Mr. Polos pulls another rabbit out of the hat next week and decides to go to a hike at consecutive meetings.
Very briefly, last question. Tropical Storm Harvey and our good friend, whatever his name is, in North Korea, are they the two major factors affecting the market near term?
In the near term, yes, but then that goes outside of the fundamentals, because the fundamentals we all look and monitor at on a daily basis. Pyongyang and Kim Jong-un and Trump's tweets clearly impact the market on an intraday basis. So we come in, you wake up every morning and just another missile has been fired or Trump has fired off another tweet. So those are clearly issues that are dynamic and you can't model, you can't extrapolate. And tropical storms will, of course, that will have an impact on the fundamentals going forward as we think about the ramifications of employment in terms of growth, in terms of the energy components outside of that as well. But beyond that, those are the sort of the two non-linear market-related events to consider.
Jeremy, thank you very much for joining us.
Pleasure.
Have a lovely weekend, and we will see you next week. Thank you very much.